Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, April 28, 2015. Inside the numbers tonight, we're going to go over the SPY and the E-mini contract. I've got numbers, both support and resistance levels. We'll discuss crude oil. We'll talk about gold and the GDX. We'll talk about interest rates in the bond market and the U.S. dollar. Also, as a bonus, I've got a little discussion we're going to have on Apple because it's so big and important to the market. And then I also have another stock that I want to show you an example of a specific pattern and how it might play out. And we'll watch it in the coming days, weeks, months, whatever. So let's go over. Let's go right into the charts. And here's the daily chart of the SPY. Now, in last night's video, I told you that if we had any downside today, and I put this level in at 208.97, I basically said it was 209, and let's zoom into the hourly and see where we went today. Okay, right down here, we came to 209.33, so we were about 35 cents away, but nevertheless, I knew that this area was going to be good support for the day, and we didn't even get there, and that's also of a bullish variety. So when we don't get to the target levels, like we should have got there on the downside, we should have hit that 209 level and pierced through it. When that doesn't happen, that tells me that there's a bullish undertow to the market. There's a bid to the market, and so we'll just we'll go with that. And then market kind of reversed, went higher, and now we're in that holding pattern, waiting for the Fed. I think it's every month. It seems like every month. We seem to be waiting for the Fed. They have their Tuesday, Wednesday meeting. They come out with a phony announcement on Tuesday of what they want the public to believe that they talked about. Okay, this is just the public release. It's not actually what went on. Okay, and everybody parses the words. The economists come on and they dissect the words and the verbiage. And did they say this and they left this out and they put this in? It's all bull. It's nonsense. The reality is all we give a hoot about is how the market reacts to what the Fed says. Not what the Fed says, but how the market reacts to what the Fed says. I don't give a shit what they say. I'm not even going to listen to what they say. But we're going to pay attention to how the market reacts. And what we want to see is for the market to have a takeaway where the market believes the Fed is going to remain accommodative. If the market believes anything other than that, they're going to send us down, okay? But if there's a hint of dovishness in the air and we think that the Fed is going to remain accommodative and that the whatever the statement makes, the market, we want the market to take it, if you're long, the market to take it as they're going to remain with a bid under the market. The Fed's going to be bullish. They're going to support the market, blah, blah, blah. We'll see what happens. The announcement comes at 2:15 tomorrow. The market generally will whip around. It will go up. It will go down. It will go up. Or it will go down. It will go up. It will go down. Either way, it's always going to go in both directions at minimum of one time, most of the time at least twice. Okay, so where do we have on the upside? Well, let's flip over to the E-mini for those E-mini watchers. And today, remember that level was 2085, and we got down to 2088, 2088 and a quarter. So same routine as the spider. We just missed it, and then the market reversed. But on the upside, let's look at what our upside targets are. So the next upside target of relevance that I have is 2023 to 2025. Okay, so it's basically, let's call it a dozen to 15 points higher on the upside from here. Okay, in that ballpark. When's that going to happen? Your guess is as good as mine. Could it happen tomorrow on a positive reaction to the Fed? Absolutely. No question about it. But if we go the other way tomorrow, and by the way, the upside, one more beyond that is 2130 to 2135. So it's 2123 to 25 and 2130 to 2135. Those are numbers. In fact, the 2130 to 35 number, I was giving you folks back in as early as I think even November, maybe even before that, as an upside target that needs to be achieved, needs to be satisfied before this market could go anywhere else. Well, We're creeping, creeping, creeping. Now, before it looked like pie in the sky. Now it looks like reality. And so those are my upside targets. What's the downside? The 209 remains, or 2085 on the ES contract, remains formidable resistance, or I'm sorry, support. And then we have 2070 and 2055. On the spider, excuse me, if we flip over to the spider, we have 209 or 208.97 to be exact. We have 207.50 and we have 206. Beyond that, we don't need to worry about it unless we really start to sell off and you know, and the whole complexity of the market changes. But I don't anticipate that happening over the next couple of days. Okay, so that should give you a bird's eye view of where we stand. You know, trading in front of the Fed is a little bit risky, a lot risky. It's not that smart. It's basically guessing and gambling, and that's not the business, at least I'm in. So most likely I may decide to take a position after the Fed announcement, but as it stands right now, in terms of the SPY, or the ES contract, I'm flat, okay? I have no dog in the fight one way or the other right now. I took a position I had off right at the close today, knowing that tomorrow's most likely going to be flattish, waiting for the Fed at 2:15. So in between that, you'll normally trade in a very narrow range all day, and there really was no reason for me to have any risk on the table. Remember, my inventory is my capital. Your inventory is your capital. Without inventory, I can't play. I can't be in business. So I put my capital back in my pocket because the risk was to the downside. Waking up in the morning, I didn't need any shenanigans. Okay, let's go over to gold. Oh, you know what? I wanted to talk about two other things. Real quick, let's go over Apple because Apple is so important to the market. But I want you to see what happened today. What was very important was Apple came out with earnings last night. The market was up, or Apple was up. And then in the end of the day, to make a long story short, Apple put in a reversal day. It finished down. Now look at the hourly chart, okay? You went up and you spiked down. That's never a bullish sign. That's the sign of distribution. What's distribution? It's when the institutions, the large shareholder players, are distributing stock to normally the individual investor, the retail investor that was scrambling to buy at the open to try and ride the Apple train up higher. And what happened was those folks were buying it from the institutions. The institutions dumped shares onto the market. The retail investor couldn't swallow it. The stock started going down. The retail investor throws up his or her stock, and now you have basically a scaling down of the stock and somewhat of a small watershed decline intraday anyway, and here it was, okay? So you go from basically 135 down to 130 inside of an hour. So that's distribution, folks. And, you know, the market tried to recover, but we failed at the end. And what this tells me is Apple wants to go lower, okay? Usually you won't have a day like this where you see real bona fide distribution. A 5-point swing in Apple from high to low today is distribution. Make no bones about it. So what's going to happen from here is we have to watch to see how Apple reacts over the next several days and what the pattern the chart develops, or what chart pattern develops going forward. And if we can get some kind of a sideways pattern developing, that could signal lower prices ahead. If we bounce back, so be it. But I'm just suggesting that the probabilities say more downside is in the cards for Apple. Now, if there's more downside in the cards for Apple, is that going to take the major market down with it? Remains to be seen. Most people don't remember this, but a couple of years ago, Apple was down, 20 or 30% in the course of a year or so, and the market was up. So not always the case when you hear, so goes Apple, so goes the market. Not always the case, but it can be. So it's just something to be aware of. There was something else I wanted to discuss with you before we move on. And I know this is going to be another one of those long-winded videos, but I want to show you a chart of Yelp. Why? Yelp has earnings after the market closes tomorrow. Okay, what does this purple line signify? Well, I'm going to show you. What I'm going to show you is a what looks to me, okay, at least in my work, a bona fide head and shoulders pattern. Now, I'm going to show you a little bit about this. Well, it's on the weekly chart, okay? Head and shoulders pattern, okay, target. Target meaning what's the price level I would expect Yelp to drop to? Oh boy, why? Let me explain how to calculate a head and shoulders pattern, and this is a pretty good one, okay? Here's your left shoulder. Here's a head, which is higher. Here's a right shoulder. Here's a trend line connecting the bottoms, sloping in the correct direction from bottom left to top right, okay? And this is, in my book, a bona fide head and shoulders. You broke the line, the shoulder, the neckline. This is called the neckline. Okay, you broke the neckline, and then you came back and you retested it, okay, yesterday and today, okay? Now, if you close the week, this is a weekly chart, so by Friday, if you close above this line, it's off the table, okay? That's item number one. No two ways about it. But if this trend line repels price one more time, okay, or this final time, okay, over the long term, how do you calculate the price target of a head and shoulders pattern like this? Well, without a calculator and without any kind of geometry whatsoever, I'm going to show you a simple method. What's the high? 101.75. Where does this fall, this neckline fall? Right about, let's call it 51, just to be on the safe side. It could be 49 and change, could be 50 and change, doesn't matter. We'll call it 51, okay? You take 51, you subtract it from 101 and change, and in this case, what do you come out with? Nothing. You come out with basically a bankrupt company. Now, I'm not suggesting that this company's going bankrupt and it's going to fall $50 after earnings tomorrow. Don't misunderstand me. That's not what I'm saying. A weekly chart it literally could take years to play out. It could take months. It could take years to play out. All I'm saying is, if this pattern played out to the tune, the textbook method of what a head and shoulders pattern, how to calculate a target is, it basically puts this stock at zero, $1, $1.50, zero, less than $1, depending on where the exact calculations fall. It really doesn't matter. Okay, but the point is that, and I'm not even suggesting be short into earnings. That's another gambler's game, right? You don't know which way the stock's going to react into earnings. In fact, let me show you a reason why not to do that, okay? I'm going to bring up a daily chart of Yelp, and I'll show you that what happens, this is the same neckline, what happens if the market perceives earnings as positive and we gap higher? We're going to go fill this gap here at $56, okay? I don't want to be there for that. I don't want to be short a stock for a $5 run up higher. So we don't know how the market's going to react to earnings. And if that happens and we closed above this neckline tomorrow and we stayed above there and closed there by Friday, then this pattern's off the table anyway. So you wouldn't do something like this, finding it today and then doing it a day before or the day of earnings announcement. You wait till earnings, you wait till the shakeout. Listen, if this is going to play out, there's plenty of downside for everybody. All right, let's go over to gold. Hopefully that's helpful. I just wanted to show you. I thought it was interesting. I found it today, and I just thought it was just an interesting pattern that just seems to be playing out picture perfect. We'll see. All right, gold. Okay, we had another update in gold, and we went to the 212 target. Pierced through it a little bit, but you see this target was in there. I talked about 212 a number of times. From here, we may have to consolidate for a couple days, or we may just shoot higher. But my ultimate target that I don't think we're going to get through without a correction or a pullback is about 1230, 1231, a pierce of the 200 period moving average, right up in this neighborhood here, this top purple line. So that's where I think we're going in gold. That's actually what I would consider maximum upside for the time being. After that, we'll probably have to pull back, and maybe you'll see one of those ABCs I love to talk about so much, right? A, B, C. So that's not out of the question. This could be an ABC. A, B, C, and then this could be a smaller ABC. A, B, C. These play out all the time. A, B, C. This is an ABC, obviously. Okay, so downside, your downside, I believe that you would, based on some calculations I've done, I believe you would find if we did pull back in gold, in the short run here, instead of going higher, I think 12.95 would be formidable support, and I would be okay with stepping in there if you want to be long gold. 12.95 would be a decent level if you got down there. And then 11.95 here, and then 11.91 was a prior support number or support number that I believe would also be level of support, but those numbers are close together. 11.95 is this purple line. I think that would be great support. Okay, GDX had a great day today, up 3.5%. So where's the top end here? It's pretty simple. As long as gold goes higher, you're going to probably go into the 200 period moving average. My calculation brings us to this pivot high here, 21.38. I think you probably pierce through it and get up to 21.50 top end. I wouldn't be holding that long. If the market is strong and it's going higher, anything over 21, I would be selling into the buyers. I would be a seller into the buyers, meaning sell into strength. Let's go over to the oil market. So the daily chart looks the same, but we can't get over 58. It kind of tried early in the morning when we had that rumor that came out about Iran, something with a vessel in the Strait of Hormuz. Turned out not to be a U.S. vessel. It turned out to be maybe a Dutch vessel. I'm not sure. But as soon as some geopolitical news about a conflict, a potential conflict with the Iranian Navy and our Navy came out, all of a sudden oil started to inch higher. And then that turned out to be a little bit overzealous in terms of a rumor. It was somebody else. Oil pulled back. But here's you're making a great bullish pattern. The question is it going to play out? Well, nothing's changed. You've got to get over 58 and start to close hourly above that number. Okay, so I don't know where I was. I had to pause the recording there for a second because I spilled water all over my desk. Wonderful. Anyway, so what I'm saying is that we have to get over 58 for there to be a rally higher and begin to close hourly above that number. So it didn't happen today. In fact, let's look at the hourly and zoom in and see where we are. Okay, so right here, you kind of made the attempt early in the day. It didn't really get to 58. In fact, the high was 57.83, and then we just rolled over, and then it finished weak throughout the rest of the day. And so I don't know. As long as we don't get above 58, you can't be long. So this is one of those circumstances where it looks like oil wants to go higher, and then under normal conditions, I would be long this pattern, waiting for a pop higher, and you would normally get a pop, somewhere in the neighborhood of the extent of this candle here, which has a low of just under 55 and a high of almost 58. So you might almost get a $3 pop out of a pattern like this in the spirit of synergy. But here's the problem: as long as I don't get a close above 58, I'm not going to do it. So in that case, what this is it's kind of like waiting for confirmation. You will make probably less money on the trade, but I'm going to lose less times. And what I'm trying to say is I'm going to lose less when I wait for confirmation, and I've kind of proven this out over the years of doing this. So normally I would take this trade saying, well, it looks like it's going to go higher anyway, and then it doesn't work out, and then I ended up taking a small loss. Well, here I'm going to wait for us to get convincingly over this line, over 58, close above it, first hourly and then daily. And then even if I'm at 59, knowing that we can go up into the 60s, I'll take a smaller gain, but I've got more of the probabilities in my favor that I'm going to make money. And to me, that's a better scenario. So that's just one of those risk management, money management issues, not really chart pattern, but more money management issues. Let's go over to the bond market. I'm going to bring up the TLT, and here you're in the middle of the range. I think you're going to get down to this 125.50, and what I put there is a secondary support level if we really broke hard on the downside at 122.97. Call it 123 or a break of 123, and your upside is not much more than 133, 132.76 to be exact. And so you're in the middle, so there's really no trade here until you come down to one of these levels. Once you come down to 125.50, depending on how we get there, I would think that I may be prime for a trade, but we have to see what the market looks like when we get there. But this is going to be good support. I've got this as a pretty solid calculation that I made 2 different ways, and it came out with the same number. And, 2 guys, 3 guys tell you you're drunk, go sit down. In this case, I think 125.50 will hold, and I think it'll hold for a while. The dollar, guess what? Into the zone. Finally, the dollar came back to the zone. Remember this day here when we spiked lower after hours and it was down here for about 2 minutes? And I said, we'll probably come down there again and retest that level. Finally, we're getting into the zone. And we may come down tomorrow farther. When the Fed speaks and they release a policy statement, normally all the markets whip around. The dollar in particular, currencies, precious metals, commodities, the stock market, everything whips around. So it's not out of the question for us maybe to even get a flush lower in the dollar tomorrow, come into the middle of the zone, and I'm already buyer. I'm already owning the dollar. I'm gonna absolutely buy more tomorrow, one way or the other, whether it's at the top end of this zone or in the middle of the zone or the bottom of the zone. I really don't care. Why? Because we know the dollar is going to be 105 to 110, 105 minimum to 110, and it's the rally is going to begin this year, most likely in earnest in the second half of the year. So now's the time to start to collect the dollar on weakness, because this is one of those trades where I can almost see it as clear as day. It's a 98% trade. There's always 2% chance it doesn't work out. But on this particular case, I'm 100% sure I'm right, and that's just the way it is. That's the way it works in this one. So that's about all I have for tonight. I know it was a little choppy tonight, but hopefully it's been helpful. Hopefully I'm giving you good price levels, good information. Hopefully you're learning something. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.